Okay.
Yeah, so let me just share the screen.
Okay.
Yeah, so I was talking about computer assisted auditing techniques, right? So what are computer assisted auditing techniques? So these are just
Yes.
techniques. Um, these are tools that the auditor uses to gather data. So this is just something that you need to know. Computer assisted auditing techniques, they just help the auditor uh, collect data. So instead of go, so initially when the auditor is collecting data, what we do, we sample. We can't assess or analyze all the items of the financial statements. So we just sample, then we make a decision based off the sample that we were able to gather. But now these computer-assisted auditing techniques, they help the auditor analyze data in large amounts such that the whole information in the statements of financial position or statement of profit or loss, they can be able to be analyzed. So that's one of the advantages of computer assisted auditing techniques. So it helps analyze data. Then the process also can be customized. So the auditor can introduce test data into the client's financial system to identify issues or use their own audit software to to make sure they carry out the audit. So it also boosts the efficiency. So the auditor may be able to focus on key critical audit matters instead of spending excessive time analyzing data. So these are just some of the points that you need to have an idea of in case they ask about computer assisted auditing techniques. So they just help the auditor analyze data such that they can be able to cover a lot of information, and their efficiency is also boosted because they're able to focus on key essential areas of the audit as opposed to manually carrying out the audit. So now, this is now a very, very important section of auditing, financial statement accession. So I want you to pay particular attention because these are quite important when you are looking at substantive testing as well as tests for controls. So, what are financial statements assertions? So, in simple terms, an assertion is a statement that is true, right? An assessment, a statement which you feel is true. So, when managers prepare the financial statements, they are telling us, saying, these financial statements that we've prepared, we believe that they are accurate. We believe that all the transactions have been included. We believe that everything has been included according to how it's supposed to be presented. So these are financial statement assertions. So now the auditor comes in, says, okay, management, you have told us the transactions are correct. Let us test the accuracy of the information. By presenting these financial statements, the CFO and the CEO, they have signed these financial statements, and you are certain that um, all the information has been classified as it is supposed to. So now, as auditors, let's test the classification. If everything has been classified as the way it's supposed to be classified. So these are in financial statement assertions. So these are just statements that the managers uh, deem to be true. Then the auditor uses that information to test the data. So now there are two types of classes of assertions. Now those assertions which are relating to the statement of profit or loss, and there are those that are relating to the statement of financial position. The transaction relating to the statement of profit or loss, they look at the revenue as well as the expenses. So these are assertions for transactions. Then there are also assertions for assets, liabilities, as well as equity, which are assertions for the statement of financial position. So now, the first assertion is occurrence and authorization. So now, what occurrence and authorization looks at is one, did the transaction happen? And was it approved by the senior staff? So if you're carrying out an audit, you go into the business, you're testing maybe sales, right? There was a sale of 10,000. We're trying to prove, did this sale happen? So what does the auditor do? The auditor asks, was there authorization, right? Did this sale occur? Do you have invoices? Do you have goods dispatch notes, right? Then that's testing for the occurrence of that particular sale, right? Then accuracy. Was it recorded at the correct quarter amount? So when we're testing the accuracy, the assertion of accuracy, we go into the ledgers, we get an invoice, then we ask the accountant, say, okay, show us where you recorded this particular invoice that we have. Then we go to the books, we go to the ledger, then we compare what's on the invoice and what's recorded in the ledger, so that we're able to test for accuracy if that particular transaction was recorded at the correct quarter amount, the correct amount that's supposed to be reflected in the books, which is consistent with the particular invoice. Then completeness. Are all relevant transactions captured in full, right? All relevant transactions, are they captured in full? So the best example for this is where we've got the double entry, right? So when you make a sale, obviously you need to credit the sales ledger, then you debit. If it's a credit sale, you debit the customer account. So now we have to check, was this transaction completely recorded, or maybe was it just recorded as a sale, then the other follow-up entry wasn't recorded. So now we need to test the completeness of that particular transaction. Then cutoff. What is cutoff? Cutoff simply means, was the transaction captured in the correct period, right? This usually happens at the end of the financial year, where you've got today is the end of the financial year. Then tomorrow we begin a new financial year. Then you receive an invoice, or you receive maybe a payment for an invoice which was issued last year. So you receive it in the following year. So sometimes accountants may record that particular transaction as though it happened in that new year. But meanwhile, the amount is relating to an invoice which is from the previous year. So now, when we're testing cutoff, we're trying to test, was this transaction recorded in the correct period, right? So we need to check. We get an invoice, right? We have this invoice. We ask the accountant, show us where this invoice was recorded. Then they say, okay, it was recorded in this particular ledger. Then you check the dates. Okay, the invoice is for last year, but it was recorded in 20. Let's say last year is 2023. Then it was recorded in 2024. Then there's a misstatement. We have to tell them, okay, no, you need to adjust, record it in 2023 because this invoice relates to last year. And that's what cutoff is. Cutoff is basically, when was that transaction recorded in the correct period. Then classification, was the transaction posted in the right account. So sometimes, if due to nepotism you employ a nurse as an accountant, right, instead of posting the transaction accordingly, you make a sale, they post the sale in the sales account, then the other double entry, they post it maybe in an expense. They debit an expense, they credit the sales account, right? So now, us as auditors, we need to check. We get an invoice, for example, again, this invoice, how was the double entry? Was it recorded in the right accounts? So if we discover that the one entry is in the sales, then the follow-up uh, entry is in the expenses, then we can be able to tell, okay, here there's a misstatement. Then presentation and disclosure, all transactions have been aggregated and disaggregated in the financial statements. So we all know, when you're preparing the trial balance, these individual accounts for suppliers and customers, they need to be aggregated in the control account, right? When they're aggregated, then we create that aggregated receivables amount.
Yeah.
That's the one you post to the statement of financial position. So now, when the was this amount properly aggregated? Were these amounts properly aggregated? Were these amounts properly added together? So this is what we ask when we ask for presentation and disclosures. Then there are some times where they are required to be disclosures, right? Maybe the company was acting as an agent, right? We need to disclose saying, okay, the amount of income that we earn is ABCD, then we only earned 10%, then the rest of the amount out of maybe a 1 million invoice, we only earned 10%, then the rest of the money is what is commission. So is there a disclosure which has been presented in the notes to the financial statements? So these are the assertions for transactions which are revenue and expenditure. Any questions?
No questions.
Okay. So now we also now need to look at the assertions for assets, liabilities, as well as equity. So now for assets, liabilities, and equity, there are those that are similar. There's completeness, which is similar to those of transactions. Then there's also cutoff, which is also the same explanation for those in the transactions. Then even presentation, right? They're also similar, right? So now we've got existence. Existence is one of the different ones. Existence simply means,
Okay.
does the asset or liability exist? Is it real? And that is why we come as auditors to ask you as the company, where are your assets? Show us your assets. The assertion that we're trying to prove here is existence. Does the asset or liability exist? If it exists, show us where it is. We want to see it. We want to touch it. We want to feel it. Sometimes you can record assets which are non-existent, right? And that's so that you make the financial statements look healthy to entice the shareholders, right? But maybe the assets don't exist. So for us to test the assertion of existence, we need to tell the client, show us where the assets are. We want to see them, all right? Then two, valuation and allocation. Has the asset or liability been valued accordingly, right? Has the asset or liability been valued accordingly, right? So maybe, for instance, an asset, is usually revalued. That revaluation, has it been revalued appropriately? That's what we're asking. Sometimes are assets valued according to the applicable financial reporting standards. So sometimes valuing when you're valuing an asset, like, okay, let's just say the PPE, right? Are those costs, maybe the cost of purchase, the the incidental costs to making sure that the asset is brought into its right state of use, the the present value of all future costs of dismantling, have they been calculated appropriately so that we can be able to value this particular asset, right? This is what the valuation assessment is all about. Hello, okay, can you get me now? Hello? Hello? Hello?
Hello?
Yeah,
I'm
can you get me?
getting you.
You're getting me now?
Hello?
Yeah, can you get me?
Yes, I'm getting you.
Okay,
Yes,
we can carry on, huh?
yes, I'm getting you.
Yeah. So now, so as I was saying,
Yes, I
yeah,
can get you.
yeah. So now we ask, we ask now, is the asset valued accordingly? Has the valuation, maybe if there's a revaluation,
Yes,
has it been allocated accordingly to how it's supposed to be allocated? Then rights and obligation. What are the rights and obligation? Does the company own the legal rights to uh, that particular asset, right? So sometimes we can ask, okay, when did you buy this particular asset? Like, show us maybe if it's okay, if it's maybe a lease, a lease, if it's a finance lease, show us your lease agreement so that we can be able to prove that indeed for the next 5 years you own this particular property under a finance lease. So then obligations, do you have any obligation to liabilities? Is it true? So maybe you've got payables. We need to call those suppliers and we ask them, are you truly owing, or is company A truly owing you such and such an amount of money? Then that particular supplier is going to what? Is going to confirm, right? So that's what rights and obligations are. So when you're testing the rights and
yes,
obligations assertion, we're just trying to test is, does the client really own the assets, or does it have an obligation to offset the liabilities? Then completeness, are all relevant assets and liabilities and equity captured in full? It's just the same. The completeness, like the one we are from just discussing. Then there's also classification as well. Classification, it's just the same as well. Classification, have the assets uh, and liabilities been posted in the correct accounts? Classification, yeah. So yeah, so basically that's it about assertions. So these assertions are very important because we use these assertions to test the controls, to carry out substantive testing. These are the assertions that we use. I don't know if it has made sense.
yes, that's made sense.
Okay. So any addition or subtraction?
Hello?
I'm saying any addition or subtraction?
Uh, okay, just an experience of uh, when we are doing the system audit or the technological audit. So
Mhm.
I was working for a telecom company. I told you about Vodafone, right?
Yes.
Hello?
Yes, yes, yes.
Yeah, maybe you can end the recording.
Oh, yeah, I forgot. Remember I told you I've got a chicken memory, huh?
Yeah, yeah, you can end the recording.
Okay, just a minute.
Your memory is very good. It's us who don't remember things. Yeah.
All right, but this most